Chapter 5: The Rise of Crypto Exchanges. By the time Bitcoin began its first major price surges in 2013, a new infrastructure challenge had emerged. How could people trade cryptocurrency for fiat money? How could the growing community of miners, early adopters, and speculators convert digital coins into dollars, euros, or yen, and vice versa? The answer came in the form of crypto exchanges, digital marketplaces that would become the backbone of the cryptocurrency ecosystem. Their rise would mirror the evolution of crypto itself: rapid, chaotic, innovative, and at times dangerous. The first forays: early trading platforms. Bitcoin began as an experiment on mailing lists and forums. For months, transactions were peer-to-peer. A miner might sell coins to a friend via PayPal or swap Bitcoin for a pizza, as in the famous Laszlo Hanyecz transaction in 2010. But as Bitcoin's popularity grew, informal trades became cumbersome. There was no standard price, no liquidity, and no safety guarantees. Entrepreneurs saw an opportunity: digital platforms where users could buy, sell, and store cryptocurrency safely and efficiently. Bitcoin Market, COM 2010, often cited as the first Bitcoin exchange, Bitcoin Market allowed traders to buy and sell Bitcoin using US dollars. Its volumes were tiny, but it created the concept of an open market for Bitcoin, establishing the foundation for future exchanges. Mt. Gox, 2011. Originally a platform for trading Magic, the Gathering cards, it pivoted to Bitcoin and soon became the world's largest exchange. At its peak, Mt. Gox handled over 70% of all Bitcoin transactions globally. It centralized liquidity, created a market price, and provided an interface for a growing community of traders. These early platforms were experimental, sometimes unstable, but revolutionary. They turned Bitcoin from a niche hobbyist currency into a tradable asset, opening the door to speculation, investment, and global attention. Features that defined early exchanges. Crypto exchanges were not just digital marketplaces. They were technological innovations that solved several problems simultaneously. Price discovery. Exchanges provided a transparent mechanism for setting the market price. No longer did sellers need to negotiate individually. Buyers and sellers could match automatically. Liquidity. By aggregating traders, exchanges allowed faster transactions and easier conversion between crypto and fiat. Security measures. Exchanges developed wallets, cold storage, and multi-signature features to safeguard user funds. Though still imperfect, these innovations reduced the risk compared to ad hoc trades. Accessibility. A centralized platform allowed newcomers to enter the market without needing deep technical knowledge. For the first time, Bitcoin became liquid, measurable, and mainstream adjacent. It was no longer just a protocol or a code experiment. It had a market. The Mt. Gox phenomenon. Mt. Gox deserves special attention because its story is inseparable from the rise of exchanges. Founded by Jed McCaleb in 2010 and later sold to Mark Karpeles, Mt. Gox quickly dominated the Bitcoin trading world. Its growth reflected the explosive demand for a centralized, easy-to-use trading platform. Traders from around the world flocked to Mt. Gox because it offered fiat-to-Bitcoin trading pairs, USD, EUR, JPY, a simple user interface, real-time market data, relatively high liquidity compared to forums or peer-to-peer trades. At its peak in 2013-2014, Mt. Gox handled hundreds of thousands of trades daily, and Bitcoin's price movements were closely tied to the exchange's order book. Yet with great power came great vulnerability. Mt. Gox's infrastructure was notoriously weak. Poor security protocols, lack of internal audits, slow withdrawal systems, insider mismanagement. The vulnerabilities would culminate in the infamous Mt. Gox collapse of 2014, when the exchange filed for bankruptcy after losing 850,000 BTC, worth hundreds of millions at the time. Lessons from Mt. Gox. The Mt. Gox collapse was catastrophic. but it was also transformative for the crypto ecosystem. Security became paramount. Exchanges began prioritizing cold storage, multi-sig wallets, and professional audits. Diversification. Users learned not to store all funds in one platform. Regulatory awareness. Governments realized exchanges could be weak points for fraud, theft, and money laundering, prompting future licensing and compliance requirements. Mt. Gox's rise and fall created a cautionary tale. Exchanges were necessary for growth, but they introduced new systemic risks. The proliferation of exchanges. After 2014, the number of crypto exchanges exploded globally. Entrepreneurs and developers launched platforms to meet growing demand. Bitstamp, 2011, one of the oldest surviving exchanges, based in Luxembourg, focusing on European fiat pairs. Kraken, 2013, founded by Jesse Powell, known for robust security and transparency. Poloniex, 2014, focused on altcoin trading, offering dozens of trading pairs. These platforms diversified the ecosystem, allowing traders access to multiple cryptocurrencies, better prices, and more liquidity. They also professionalized the industry, bringing advanced features like margin trading, futures contracts, and lending platforms. Technological innovation in exchanges. Crypto exchanges evolved beyond simple buy-sell platforms into complex technological ecosystems, order books and matching engines. High-speed engines allowed thousands of trades per second, critical for volatility and liquidity. APIs. Developers could build trading bots, analytics tools, and applications that interface directly with exchange infrastructure. Security protocols, cold storage, encryption, DDoS protection, and withdrawal limits became standard. Mobile and web access. Platforms evolved to meet mainstream expectations for usability, enabling global adoption. These innovations mirrored the development of financial markets in traditional finance, but in a decentralized and permissionless ecosystem. The regulatory tightrope. As exchanges grew, they also attracted regulatory attention. Governments worldwide faced new questions. Should exchanges be licensed as financial institutions? How to enforce anti-money laundering, AML, and Know Your Customer, KYC policies. Could cryptocurrency trading be taxed? Exchanges had to navigate this tightrope carefully. Some embraced regulation, Kraken, Coinbase, building credibility for institutional investors. Others stayed unregulated, appealing to privacy-focused users but risking legal action. The regulatory landscape would continue to shape the rise of exchanges in subsequent years. Impact on adoption and culture. Exchanges were more than just marketplaces. They were cultural hubs. They onboarded new users, transforming cryptocurrency from a niche hobby into an investable asset. They created communities as traders shared strategies, tips, and experiences online. They enabled speculation, fueling bull runs and bringing global attention to Bitcoin and altcoins. By giving digital assets liquidity, exchanges allowed prices to reflect belief, demand, and hype, rather than being static or purely theoretical. The altcoin exchange explosion. As Bitcoin matured, so did altcoins. Exchanges began listing hundreds of tokens, creating a new class of investment opportunities. Poloniex and Bittrex became central hubs for altcoin trading. ICOs, enabled by Ethereum's smart contracts, brought thousands of new tokens into circulation. Exchanges acted as gateways for innovation, letting users experiment with new projects while creating new markets. This period saw the beginning of crypto as a full-fledged financial ecosystem, with diverse assets, liquidity pools, and speculative opportunities. Security and scams growth also brought danger. Exchange hacks and scams became part of the story. Bitfinex hack, 2016. $72 million stolen, shaking confidence. Coincheck hack, 2018. $530 million stolen, highlighting the ongoing risk of centralized custody. These incidents reinforced a central lesson. Users must balance convenience with security. Exchanges were indispensable for adoption, but they were also targets for criminal activity. Exchanges and market psychology exchanges shaped not only trading, but also perception. Price discovery on major platforms became a global reference. Whale trades, order books, and trading volume influenced sentiment. Fear, uncertainty, and doubt, FUD, spread faster than ever through exchange data leaks and media coverage. The rise of exchanges transformed cryptocurrency into a psychologically driven market, where behavior, sentiment, and perception were as important as technology. Global expansion exchanges became global phenomena. Asia, China, Japan, South Korea dominated trading volume for years. Europe, Bitstamp Kraken, offered compliance and fiat integration. North America, Coinbase, focused on security, institutional adoption, and mainstream usability. This global expansion helped cryptocurrency move from tech enthusiast circles to institutional and retail markets, laying the groundwork for the 2017 bull run. Conclusion: exchanges as the backbone of crypto. By 2017, exchanges were no longer optional. They were the lifeblood of the cryptocurrency ecosystem. They made Bitcoin and altcoins liquid and tradable, enabled price discovery and market growth, onboarded new users, fueling adoption, introduced risk, hacks, and regulatory scrutiny, created culture, communities, and speculation dynamics. The rise of crypto exchanges marked a transformational period. The world no longer viewed Bitcoin as an obscure experiment. It was a tradable, investable, and headline-grabbing asset class. Exchanges had done what no mailing list or forum could. They connected the scattered pioneers of cryptocurrency,